Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
Well, welcome back. Had a nice seminar this morning. Thank you to everybody that showed up. We had been about 85 people there, I think. Yeah, not bad. Always fun for me anyway. But feel free to call us today, 216-901-0945, 216-901-0945, if you have any questions. We're going to be talking about a couple of the same things we talked about this morning at the today's workshop. And if you hear some of this and you've got questions, feel free to go to my website and send it in. You can click on the contact form. Our phone number's there. Feel free to reach out to us. We'll try to get back to you as quickly as we can. One of the things I pointed out was how different portfolios, different styles can perform over time. And the differences in their performance, and how it's important to have more than one asset class or one type of even stock portfolios in your account. Mutual funds that don't have a lot of overlap, that are just different. And the goal is to try to smooth out the ups and downs without killing the performance. But if you can smooth the ups and downs out a lot, it just makes it a lot easier to put up with when you're watching it. People today, they watch pretty closely because they can. You can get online and watch things extremely closely. In fact, we rolled out a service that we're going to be rolling out to all of our clients. So if you're a client, stay tuned. We're getting there as fast as we possibly can. And we have to do them in shifts. But over the next 4 weeks, you'll be getting an email and an invite to sign up for this free financial program that we're using. It's all web-based, and we'll be talking more about that on future shows. But right now, that's kind of where I'm going to leave it. It's like a financial dashboard, a way of looking at your entire financial picture on one page. Just makes it easier. So maybe we'll come back to that a little bit later in today's show, but I want to continue with what I thought I was starting off with, is that I showed an example of Russell Midcap Value Trust, that's an index, and relative to the S&P 500, which is also an index. That's the one most people are familiar with. When most people say the stock market, that's actually what they're referring to, which is not the stock market. It's the S&P 500, but that's okay. I get it. It's just the semantics, but it can be pretty different. Let me explain that. So if you say the stock market and you really mean the S&P 500, if you'd put $100,000 in there in 1995, it'd be worth $800,000 today. $812,000. As of 6/30, I take that back, 6/30/2017. So end of June, a few weeks ago. If you invested the same in the Russell Midcap Value Trust, that 100,000 would be 1.3 million. Okay, that's a $500,000 increase. $500,000 increase. So why am I pointing that out? Well, because if you go and you look at the first 5 years, the S&P 500 had returned that 100,000 was worth 357,000 5 years later. 357,000. By the way, that was actually the best time period ever for the S&P 500. 100,000 goes to 357 in 5 years. How wild is that? The Russell Midcap Value Trust, the one that was worth 1.3 million in the future, and the S&P is only worth 800,000. Okay, it was only worth 223,000. It was actually $130,000 behind the S&P 500 over that 5-year time period. So for a 5-year time period, you've made a third less money. Don't tell me you're not upset. Okay. And again, you fast forward to today, and you've got about 500,000. 500,000 is what percent of 8? 8, 9, let's see. It's about an 80% increase. So you start off 5 years in the hole, and you think you're never going to get ahead again, and you fast forward to today, and you're actually 80% ahead. Why is that? Well, there are lots of reasons for it, but that's why we do what we do at Bullington Capital. It's tough. Investing is tough. It's gonna test your mettle. Now, the average investor, and I forgot what the average investor does. I'm gonna have to pull that up again. I used to download that every year from Dalbar, and I know I brought the statistic up today, but I have to look. Dalbar is a company that does research on investor behavior. That's really all they do, marketing research. And average investor doesn't come anywhere near what the average balanced fund does. So, and why? Because nobody's telling them what I just told you. Yeah, it's not uncommon to underperform for several years in a row. But if your strategy is valid in the long run, it should come out fine. It should work out well for you. So that's really all I wanted to say regarding that. If you know the strategies and you're familiar with them, then you need to stick with them. Not easy. And I'm not recommending either one of those funds, by the way. It's not a recommendation. It was just a comparison for comparison purposes. The right way today, in particular, market's different today than it was 10 years ago. And 10 years ago, it was a little bit different than it was 10 years before that. I think the market stayed pretty much the same throughout the 70s and the 80s. It wasn't really a whole lot different. You did have a lot more companies coming public back then. But then in the 90s, it really started changing. And the changes have really come about because so many more portfolios today are done by computer, and you have computerized executions. So you've got a slightly different character to the market. And that's actually opened some opportunities. I think it's opened a lot of opportunities. In fact, there are very smart firms out there that are launching products. They're launching products constantly, incidentally. A lot of them probably shouldn't be launched and will end up closing one day. But there are some very good ones that are being launched. They use factors other than just pure size. See, that's what I have against any market cap weighted index that's only market cap weighted. It's using one factor. It's using the size of the company, the value of the company's stock, one factor. And I'm not a big fan of that, despite the fact that it's actually done quite well. There are some, I think you can improve that, and particularly in the area of risk. How much does it fluctuate? How much does it go up and down in a full market cycle? How much has it gone down over time when the market's dropped? So I think you can reduce your risk. I know you can by diversifying into other asset classes, and it's a lot easier to do today, easier than it's ever been. Now, why is that? Well, because so many products have been created by a lot of smart people who knew how to try to build an index to help you diversify to try to reduce some of that risk. You'll never eliminate it, incidentally. It's never going away. But you can reduce it. And I think you need to do all you can to try to reduce that, because psychologically, it gets extremely difficult to put up with a market cap weighted index like the S&P 500 or even the Russell 1000 or the Russell 3000 or the Total World Market Index. All those are saying that they're market cap weighted. I think there's a better way, and we'll be talking about this now and in the future. I've got a little report on it. I've actually called this new ETF model the DOL equity model. If you're a client of mine, you haven't received the letter yet, it's because we're going down through them alphabetically, and we just haven't gotten that far yet. And we will. There's no hurry. Summertime is not it's not a big deal. The stock market generally doesn't do a whole lot in July or August. Actually, August, September are the 2 months that are pretty rough. They're the roughest on the stock market. At least they have been historically. I've got a bunch of reasons why I think that is. Doesn't really matter because you can't really test that anyway. But historically, August, September, your 2 worst months. Everybody remembers October. Well, I shouldn't say everybody. I just assume that people, because I know that they know, and I forget how much older I am now. So not everybody thinks that October is a bad month for stocks, because most of the people that are investing today weren't alive when those 2 big corrections came. I wasn't alive when the first one came. That would be in the 1929. But I was alive and saw the one in 1987. One day, the whole Dow Jones dropped 20%. What people don't realize, most people don't, that we're alive during that time period is that the market was already down 15% before the 20% drop. So from peak to trough, it was over 35%. Yeah, that's a big drop. That's pretty spooky. And that's what happens when you have market cap weighted, and that's the majority of your assets are in that. That's what you're going to experience. So you have to diversify. It's not as hard as you might think. Thank God that he inspired people to create all these tools that we have available to us right now. It's a beautiful thing. So I have a model that I'm running to try to get the maximum benefit of diversification without diluting the returns. And that's a major task, incidentally. Major task. Not easy to do. You can't even guarantee that you'll actually be able to do that. So, by the way, anybody that's ever telling you that they've got guarantees or is swearing on a Bible or up and down, they probably don't have a securities license, because if you had a securities license, you would know better than to say that. Get your license taken away pretty quickly. So anyway, if you'd like to call today, the number is 216-901-0945, 216-901-0945. And again, thanks again for everybody that was coming out to that workshop today. It was I probably have more fun than the people that show up. But we're talking again about a new tool we're going to use, help track your investments. And this tool, you can sign on to it. You can see everything you've got in one place. It tracks your spending. You can set alerts, kind of like the LifeLock alerts. If there's a transaction that goes through that's above a certain dollar amount, it's going to send you an email. It's a beautiful thing. To be able to track your spending, I think it's a beautiful thing, especially since you don't have to write it down. It's gathering the information for you. Security on it is top-notch. If somebody can get that information, they've already had it anyway. You have to get it from that vendor. But I think this is going to really help people going forward. There's a little financial or a retirement planning tool on there that I think is simple. Anybody that's a client or signs up to be a client, we'll go through this. We'll actually do your retirement plan. With the tool, I'll show you how to do it. You can do it on your own. Typically, if you don't know anything about this, you'll have to go through it a couple times with someone if you're brand new. But there are an awful lot of people out there that I know can do this all on their own and will appreciate the simplicity of it. It's very simple, but it doesn't leave anything out. I'm a stickler. Anybody that knows me knows that I like to be complete, but I also like to be efficient. So if the information's unnecessary, let's just leave it out. If it's necessary, we're going to include it. But if you don't really need it, financial planning, investment planning is complicated enough. You don't need to increase the complexity, because then mistakes happen. So keep it as simple as you possibly can. And I really, really like this tool. It's a great tool. We're trying to figure out how we're going to set it up. I think we're about 95% of the way there, what we're going to do. We'll set it up as a subscription product. You don't actually have to invest with us. If you do invest with us, then it's free. So that's this part of the package. And it's really cool. I'm so excited. This has been a long time in coming. We've tried this, I don't know, probably 4 times in the last 12 years. And each of the other times that we tried it, the software just wasn't quite ready, and we couldn't afford to stop everything else we were doing and try to support software that wasn't working well. Well, that's changed, and it works very well. Not that you don't still have problems, but there's a lot fewer, and it doesn't take us as much time to solve and get an answer for you. So I think that's going to be a lot of fun. Stay tuned. We'll probably have stuff on my website regarding that going forward. The other thing I like about it is you sign up and I'm not there. They have tutorial videos on how to use all the tools, the spending, the budgeting. There's a vault, a digital vault, where you can actually upload documents to it so that now you have access to it anywhere. So if you've got a deed or a will or a trust, you need you'd like to have a copy of it that's filed securely in your own personal digital vault. You can access it from anywhere you are. So very interesting. It's it's about time that they got this pulled together. And there are lots of companies that are trying to do this. I can think of at least a dozen. I've tried all of them, I can tell you, and this is the one I like. So feel free to, again, you can email us if you have questions regarding it. If you're a client, we're going to provide it for free. We'll provide instruction on it. Every seminar I do going forward, we'll actually spend a couple minutes doing one section of it so that over time, if you're coming, you'll actually be familiar with all of it at some point in time. And again, if you're a client, you just come in to the office. We'll walk you through the procedures, whatever it is you want to do with it. Or not. You don't have to. That's the beautiful thing about it. It's like a menu. You come in and choose what you like. So, having said that, I did get some requests for talking about individual stocks, and I will. The last section of today's program, I'll bring up the scans, and if I see something that's interesting, I'll let you know. It's not something that I'd spend a lot of time with these days, and that's what's also changed. The selections of products have improved dramatically for people in my industry. If you can think of a strategy, it's probably already been built. I've got a couple that haven't been built, and until the models come up that are identical to them, I'm still going to use those in addition to the other ones that are available. But if you don't know what the heck I'm talking about, that's because you just turned this on in your car and you haven't been following me for the past 10 years, so I'll stop talking like that. Anyway, we will come back after a commercial break, and I'll mention a few stocks. I have to log in here. I'm actually having trouble logging in, so I should say if I can log in to that service that provides me the scanning tools. We'll talk about that a little bit. If you guys had any calls, questions, comments, feel free to give us a call, 216-901-0945, 216-901-0945. And I guess I might as well, I don't know, we have a couple minutes here, but another topic that we'll discuss again is retirement, housing and retirement. This was brought up by a client a couple weeks ago, and I thought, I'll bet you there are a lot of people that have very similar questions to that and are wondering about that, and I was wondering about it. So anyway, all that and more after these commercial messages. Listen to Bill Bullington right here on 1420. Stay tuned. And we're back. You're listening to Bill Bullington here every Saturday morning from 11 to noon on 1420 The Answer. Also, I think we're on a podcast on the Fish.is website. But I'm going to go to the phones right now. If you'd like to call 216-901-0945. And I got Tom. You have a question for us?
Hi, Bill. How are you?
Good. How are you?
Good. I appreciate your show. I just had two questions. I wanted to ask you about two stocks that I have in my portfolio that I've done okay with. And I'm thinking about them in terms of long-term investments, really hanging on to them as opposed to taking some profits off the table, and I can't decide what to do.
Sounds good.
The first is Whirlpool. And they got hammered this week. Their dividend they did raise 10% this year, and it's one I thought about keeping for a while. It's about 3% of my portfolio.
Okay.
And the other one is Triton.
Okay, let's pull Whirlpool up. I've been very familiar with them in the past. Revenue was $20 billion last 12 months. The market value of the stock is $14 billion. That's not really that bad. That's actually pretty good, actually. Profit margin in the last quarter was 3.2%, and I want to look at That's a really cyclical business. It's also extremely competitive. You're competing with LG and Samsung and all the other manufacturers. So it's a tough business. Dividend yield looks pretty good. The valuation on it looks good, and the dividend looks really good. Having said that, it's super hyper competitive. So those profit margins are not easy to defend or maintain because they come out with a new washing machine that's the latest and greatest, and 6 weeks later, LG comes out with another one.
Sure. No economic moat, so to speak. Yeah,
it's really tough. But at this price, though, I don't think it's not bad. It's not a bad idea. It's only 3% of the portfolio. perfect. You're not.
Okay.
It's not going to kill you. And it's,
No.
So that's a good idea.
All right, good.
What was the other one?
Triton.
Okay. Is it Trident Brands?
Triton Industry. It's a container brand. They actually make containers, shipping containers, lease them.
Okay.
I don't have the.
I got
I
it.
don't have the sticker right in front of me.
It's TRTN. I got it.
Yeah.
Yeah. Now, you want to talk about cyclical?
Yeah.
That is super tough. See, I'm not a big fan of those types of industries.
Right.
They're just so unpredictable, and you just don't know what you don't know there, ever.
Right.
It's not like a Tootsie Roll, where it's candy. And
Sure.
the price of cocoa may go up a little bit. They'll just make the Tootsie Rolls a little bit smaller. They can.
I should probably sell that one.
Well, I'm just not you could do very well. Those stocks move a lot up and down, but I think it's going to be largely luck unless you're really dialed in to the heads of that industry. You know what all the trends are, and even then, most of those guys end up not doing very well in those stocks. So that's just really hard. Those are incredibly difficult.
Okay, I may get rid of that one then. That's because I'm not dialed in on any of that stuff.
Okay, now watch it go up in quadruple because.
Well, of course, that's how it works.
Right.
I appreciate your help. Thank you very much.
Well, thanks for calling.
Take care.
You too.
Bye.
Bye. Yeah, I wish I could be more help on stuff like that. I do have my own favorites, and we'll talk about a couple of those a little bit later in today's show. Industries that I think are slightly more predictable. Very few industries, by the way, are extremely predictable. There aren't a lot of them. So the vast majority of industries I would not be an investor in because of the lack of predictability, which is the majority of them. So you got to be asking the question, well, what would you like? Well, I like an industry that's not subject to swift and substantial change. Okay, that gets rid of every technology company. That gets rid of every cyclical company. I like companies that have brands. Building a brand, it has a lot of value. Very rare will somebody go and buy a generic product if the branded product that they like is sitting on the shelf next to it, even if the branded product is slightly more expensive. So what would be an example of that? Probably Procter & Gamble's the nearest one I can think of because it's the one I think has the closest valuation to what would be a normal price for it. Most of the other companies in that same space, by the way, are overpriced right now. So I wouldn't really be looking to invest in them. I don't like to buy stuff that's overpriced. And I'll go ahead and I'll tell you about the one that I was talking about. It's Discover Financial Services, DFS. And you heard me talk about this right when it was about this price, and it ran up to the low 70s. Now it's back to 62.50. And those stocks that's not a trade. I mean, this is not a trading stock. This is an investment. Now, why do I say that? Well, these guys have a profit margin of 24%. That's after tax. 24%. Credit card business is very good business. They're making, especially if they're careful who they extend credit to. And now, with all the information that they're able to collect on people, they do a pretty good job. In fact, the credit card companies generally do a lot better than a lot of banks do. They're just more high tech. Not all banks. There are some good banks out there too. And by the way, banking stocks right now, some large banking stocks, also pretty good value. And in fact, since I said that, somebody reminds me next week, I'll pull up a list and tell you which ones I think are pretty good values. Now, these are investments, incidentally. And stocks move up and down a lot. Even the blue chips, they move up and down a lot. So you got to be prepared for that. But by the way, if you're interested, and I'm sure I own DFS in more than one account. So that's the symbol for Discovery. And it's that credit card company. They're not as profitable, incidentally, as their competitors are. That's why it probably sells at a kind of a discount to what those are selling for. By that I mean in valuation. The market cap on Discovery Financial is $23 billion, almost $24 billion, and their revenue is a little bit over $9 billion. So you're looking at about 2.5. the 2.5 times sales. And I'm going to pull up Visa here really quickly. Again, I'll give you a quick comparison. So Visa's price to sales ratio is 14. Wow. You're paying $14 for every dollar's worth of sales. I wouldn't touch that with a 10-foot pole. And that's Visa. And I know everybody that purchased that stock at $37 in 2012 is going, you don't know anything. No, I'm going, no. You're going to find out what I know one day, and it's not going to be fun. And I'm sorry about that. I shouldn't be laughing or even making fun of that. But it's not an undervalued stock. And if you're paying $14 for every dollar's worth of sales, not profits, sales, that's a high price to pay, particularly with Discover, the one that we just talked about. Are they really that much better? Their profit margins are almost twice what Discover's are, because Discover's a smaller player. They don't have the same reach or the same brand that Visa does. So that's kind of to be expected. It should sell at a higher valuation, but it's selling at a valuation that's multiples of the valuation on Discover. So whether that makes any sense or not, it's probably not, because when you're out driving in a car and listening to this stuff and you don't have any numbers in front of you, it's incredibly difficult. I should probably have stayed away from that conversation completely. But anyway, if you're a hardcore stock picker, you know exactly what I'm talking about. So, but I got to stop because there are only probably one or two hardcore stock pickers listening right now. But feel free to call in with questions. You can write in with questions. Not a problem. I just got a comment on the seminar. Thanks for that from this morning. Isn't technology amazing? I mean, you're doing a seminar, and you go home, and somebody can email you from that seminar, or listeners oftentimes will email in because I've asked a question. They have questions, and feel free to do that. It's bill@bullingtoncapital.com, bill@bullingtoncapital.com. At some point in time, we might even start to simulcast the radio show on YouTube using the iPad that I have, because it'll actually do that. Isn't that crazy? Yeah, that just blows my mind that you can do that kind of stuff. So it's really interesting. It's just a fascinating world that we're living in, and it's getting more fascinating. I was in Texas probably a few months ago, and talking with one of my clients who's an underwriter for an insurance company, and they insure truck driving firms. And she was talking about the unmanned trucks that were coming up out of Mexico. They've started building highways specifically for those trucks, and they're not being driven by people. How cool is that? It's amazing, unless you're a truck driver. By the way, the truck drivers' jobs are not going away. The way that it's probably going to work is they're going to have hubs that these trucks that are unmanned are going to drive between, and then your local driver has to come and pick it up and deliver it from that hub, because they won't go from end to end, I don't think. Anyway, that's not what I've read that it was going to work like. So jobs won't go away, but you won't be driving nearly as many over-the-road hours as they used to. The super long hauls, they're going to put them on an automated truck. And this, we're talking 50 years before this all comes to fruition, because that is an awful lot of infrastructure to have to build. That's what a lot of people don't understand about America. America is about the size of Europe. The European Union has over 500 million people in it, and America only has 300 million. That's a lot less people, a little more than half. So you've got a lot of extra mileage where there are no people to transport all these goods through. So it'll happen more slowly here than it'll happen in other parts of the world. And just the way things kind of work. And North America and South America, incidentally, we're the only ones that have land left. Asia and Europe have been populated for so long that the number of people per square mile is like 4 to 5 times the number of people that it is in the United States. So if you're living here and you can still buy land, you might want to do that. Maybe pass it down to your great-great-grandkids. They'll be going, hey, thanks. But anyway, if you have a phone call, question, or comment, please feel free to call us, 216-901-0945. And, another thing I just wanted to kind of swing back around to, where we're talking about housing as you get older. When you do get older, they'll loan money to people who are retired. They'll take the income that you get from Social Security, your pension. They take a certain amount of your assets, your asset value, and they'll loan you money. They'll do a 30-year mortgage on somebody who's in their 70s, which might not be a bad idea, especially if you need to go now and you don't have the cash laying around. So that might not be a bad idea at all. And at some point in time, I'm going to get Alan Bricado at Home Savings to come on and explain a lot of those programs because they're out there. And I would not have known anything about it had a client not called and asked me about it. So thanks for that, too. And right now I'm going to have to take a real quick call. Jerry, how you doing?
Hi, Bill. Two questions. One, Home Depot guy took a bit of a hit this week in regards to Amazon saying they're going to be selling appliances or Sears appliances through Amazon, or Amazon will be selling Sears. I was wondering if you comment on that, if that could be really a threat to speak of. And, well, that's the first one I'd like.
Well, I don't know. There's an awful lot of talk that goes on that actually never comes to fruition.
Mm-hmm.
And I can't imagine that Amazon's overhead is going to be a whole lot lower than Home Depot's in that space. Because you're talking about big ticket items now that require storage and handling. And that's what Home Depot's been doing, forever. And Amazon's been doing it too. And I just don't think they have a huge edge in the margins there. So it would be kind of like a Me Too thing.
And that's my impression exactly. I kind of think it's, kind of a no blood drawn. I mean, they might take a little business, but I mean, how much business of Home Depot is based in appliances anyway? Probably
right.
a slip.
Yeah, right. Exactly. Yeah.
So I kind of wonder if the market didn't overreact. And secondly, the domestic automotive manufacturers, GM, Ford, how are they looking at the automated driving?
Oh, they're working on it. Yeah, they're working on it. They don't say a lot about it, but I know they are working on it. They're developing it. It's coming, like it or not.
Mm-hmm, mm-hmm. And you think that actually should be something of a growth for them, or to help them along?
Well, I don't know, because it might be cannibalizing the existing business. If somebody gets a car that drives itself, they're not buying two cars. They're just getting a car that drives itself and then not buying the car that doesn't drive itself. So I'm not sure. They may have to do it just to stay in the game. I'm sure I'm sure of that. And initially you're going to have the option, just like if you get to Tesla now, it'll drive itself, but normally you're driving. They have a computer-assisted driving mode, which I think is kind of interesting, very similar to the way the big jets land at the airports. And
sure.
That's out there right now. So, yeah, inevitably that's going to come. Is it going to create more cars? I doubt it. The new car sales have been around 15, 16 million since the early 1900s.
Mm-hmm. Mm-hmm.
Think about that for a second. That really hasn't changed all that much in over 100 years. The number of used cars has gone up considerably.
Well, definitely, yes. Yeah. So, okay. Well, those are my two questions.
All right.
Have a great day.
Hey, thanks. You
Thank
too.
You.
Yep.
Bye.
Bye-bye. Anthony in Parma, you have a question?
Hi, Bill. Good morning, and thanks for having your show every week.
Oh, no problem.
I've just been kind of looking around as to what to diversify some of my accounts into, and I've been reading up on these MLPs and I guess you call them REITs, REITSs.
Yeah, hey, you know what? Can you hang on for a second? I hear the music. That means I got to take a quick commercial break.
All right.
Okay, you're listening to Bill Bullington right here on 1420 The Answer. We'll be back after these messages. And we're back. Hey, Anthony, you still there?
Yes, I am. Yep, I'm here.
Okay. I'm going to have to ask you to repeat your question.
Fine. I've been looking at some diversifying, and I've been reading about these MLPs and the REITs, REITSs.
Yep.
And just wanted your thoughts on are they, something else to get into, to kind of move things around?
How long have you been investing?
About 8 or 9 years now.
Okay. How much experience do you have with individual securities?
I've got quite a few, and I think overall I've been tracking it, and I'm ahead of the game in this time period. I mean, for the 8 or 9 years.
All right. Well, here's the thing with the MLPs. You're going to get a lot of paperwork. I do like them. I have a portfolio of them. I will tell you that over the past few years, they've gotten banged around pretty good. The dividend yield, if you buy a basket of them, and feel free, you can call me in the office. I can send you a spreadsheet. It's got the basket of them that I own anyway. And
Thank you.
Yep. Yield on it right now is between 5 and 6%. It's pretty much tax free at this point, but it is a lot of paperwork. And if you do it in a fund, the fund's expenses are going to be really high. Well, I used to use an exchange traded note, which is a type of a fund. Because the expense ratio was pretty low and they passed through all the dividends without paying taxes. But I'm not happy with the ones that are left. That one had to shut down because there wasn't enough interest in it to keep the fund open and be able to pay their bills. Oh. So I just bought the a basket of them, and it is a lot of aggravation, though, I will tell you. The REITs, on the other hand, you have to be able to look at those and read their financial statements, and that's a specialty. Most of the ones that I look at are overpriced. People have purchased them because they've been really good dividend payers and haven't missed a dividend and raised the dividends. And a lot of those stocks are already priced as though they're going to keep going up, for the next 5 or 10 years, which means that there's not a whole lot of upside with a lot of those. And the ETFs that invest in them just invest in all of them, or that meet certain criteria, and the dividend yields on those are not high enough to be attractive to me. So you'd actually really have to be a specialist in that area, and you'd have to spend an enormous amount of time to be able to do that safely.
Okay.
And so
I noticed there's a few that look like they've got 11, 12% return.
Yeah, you can't look at that though. That's what directs. There's a reason that the dividend yield is that high. And it's called risk.
Right. Yeah.
Okay. So you have to go in and you really have to spend a lot of time. And if you don't know a lot about real estate investment trusts reporting and their financial statements, you're gambling. You're not investing anymore. You're gambling.
Okay. Well, that's why I'm asking, because I know a lot of them look attractive, and then a lot of them look like they haven't had much in the way of income coming in. So
right. Yep.
Yeah.
Those are tough. But good luck.
So, all right, I'll do some more reading. But thanks for the warnings on that.
Okay. All right. Well, have a good weekend.
Thanks, Bill.
Thanks. Madeline, is this my Madeline?
Yes, this is Madeline. How are you?
How are you?
Good. Hey, listen. My husband and I, he works for American Greeting, and I work for the clinic.
Yeah.
And we have 401ks there. We've been there for quite a while.
Okay.
And we've been getting a lot of communication about these brokerage links.
Yeah.
And would your services be able to help us, go through that process?
We can, especially with if it's related to Fidelity, but which I know the clinic is. We can. That's something that we're able to do, but you'd have to call to get the specific details on it. There are a lot of variables involved, but it's a possibility. Okay. So I guess you could call us at the office. You go to the website, sign up there, send us a note. We'll call you back.
Okay, and somebody told him that he's allowed a service in or something like that, or an in-service withdrawal because he's the magic age of 59 and a half. I guess that's drinking age in the financial area, I guess, huh?
Yeah, it depends on the plan, and if that's in the plan document. The clinic, I'm pretty sure, does that. But I'd have to double check.
I know American Greedy because we checked on it. So I was wondering maybe we could. What's your phone number? We can make an appointment with you, maybe to sit down with you.
Sure, it's 330-664-0700, and you could also go to bullingtoncapital.com online.
Okay, all right. Well, I'll do that for sure on Monday then.
Okay, thanks.
Well, you're welcome. Bye-bye.
Bye. And if you have any questions regarding stuff like that, feel free. Reach out to us. Go to our website. You can give us a call, 330-664-0700. We'll be glad to try to help you. We'll do the best we can. That's the bottom line. We'll do the best we can. We've got an awful lot of powerful tools, and we've been doing this for an extremely long time period. So if we don't know what the answer is, we'll find it. That's basically how we work. Also, we are actually, and me in particular, I'm a accredited investment fiduciary. Well, what that means is I had to take a course and pass a test. And it also means that I took a pledge just to put my clients' interests first. And I've always had to do that. Well, I shouldn't say always. When I left to launch Bullington Capital a long time ago, I can't believe how long ago it's been now. It makes me feel old. I did it because I wanted to be able to work in my clients' best interests and not be tempted or influenced by compensation programs. And we got a call coming in, Andrew. Yeah. So if you'd like to call us, 216-901-0945, and we've only got about 5 minutes left. But essentially, it's illegal for me not to work in your best interests. And I think when you're talking to financial advisors, you might want to ask that question. Because if you're talking to somebody from a big brokerage firm or a bank, they may not have to do what's in your best interest. There's this thing called suitability. It's not the same thing. We'll talk a little bit more about that later, but I got to take this phone call right now. And I got Walter. How you doing?
Hey, Bill. I got about 3 questions for you.
Sure.
First one is I heard you talking, last week or so about diversity.
Right.
And I want to take maybe slight issue with it, not with you, but with the whole notion of diversity. That diversity has to be correlated with how much money you have to invest. That the more, in other words, the more diverse you should be is when you have more money. When you have like 10,000 or less, you shouldn't be that diverse.
Well,
you should be more concentrated.
I think that if you must be pretty young. That's an attitude that you find with people below the age of 50. And I will tell you that it's a lot riskier to do that. And I know because I've been there and I did those things. When I was in my early 30s, I would only hold 8 stocks. And you know what? It worked very well back then, and it was very productive. Okay, today I just wouldn't do that. And I think the amount of time that it takes to follow a company, any company, you're going to spend real time. It's real work. The problem is you have a normal life that takes you away from that. Okay, so in that respect, the time it would take to develop the skills and then put in all the effort, if you're looking at only a few $1,000s, you are wasting an awful lot of time. Now, it may help you if you continue to save and invest and build that up, but normally life gets in the way. And it's, good intentions and potentially you could make a lot more money if you dollar cost average it into Apple over the past 20 years. That would be awesome. But for every Apple, there's an Enron. And, when that happens, people are broke in their 50s after saving for 20 years and being millionaires on paper. Okay, so I think diversification it's not an issue that you can really debate that well because you need to do it. And will you do better that way? It depends on luck, really. If you're lucky, you'll do better. If you're not, oh well, just another casualty.
See a stock, I think that is at least fair value or better. That's well known, and I think that's opportunity for people.
There are lots of opportunities every day.
AT&T, right now, they're about to merge, and the stock price has gone down, and it's like staying down. Well-known company, makes a lot of money, and I think you're getting it right now if anybody would buy it at a good price.
Okay, well, do you manage money professionally?
No.
Okay, so you can say that. I can't. I don't have First Amendment rights. We have to put so many disclaimers on something like that, and I will, and I do. And I will tell you this: AT&T is a great company. I use them. I use several of their products, and I can't tell you how hard it is to get a hold of the rep that I need to talk to because they are so diversified, and they're trying to do that merger. The reason they're doing the merger is, Google's actually knocking on their doorsteps. Google purchased a whole bunch of FM frequency all across the country and is going to use wireless for everything, your television, your phone, and your computer. And it's going to be 100 megabit per second. AT&T and Time Warner are going to have a tough time competing with that. So it's I don't know, man. AT&T's in one of the portfolios that I manage, but it's in there because it meets a certain set of criteria. And if that criteria is no longer met, AT&T is going to go. You know what I'm saying?
Yeah.
So I have an exit strategy when it no longer meets the criteria, it's going to go. Now that could be because the price goes way up and it's not underpriced anymore, or it could be because the business deteriorates and it's got to go. So I don't have to think about it. I already know what I'm going to do in advance whenever either one of those scenarios happens. But hey, thanks for calling. Though I got to run.
Okay.
Have a good weekend, and everybody else, thanks for listening. Good investing and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.